All right, everyone. Thank you for joining us for the January edition of the Investment Committee webinar. Hope everyone had a great holiday season and Happy New Year. We're excited to be back with you guys. We have some exciting stuff for you today, including a market update. We want to cover what happened in 2025 and what we're expecting in 2026, cover some recent news stories, and we also have some interesting charts and graphs that we want to share with you guys that are relevant to the market currently. So just want to start by going over 2025 by the numbers. I think by almost all accounts, it was a very strong year for markets. S&P 500 was up almost 18%. And I think one number that really jumps off the page for 2025 is that Vanguard Total International Stock Index being up 32% in 2025. In the last decade, there's only been two other years where the international stock index has outperformed the S&P, those being 2022 and 2017. So it's not a very frequent occurrence that we see this kind of outperformance by international stocks. The technology-heavy Nasdaq 100 also performed well in 2025, outperforming the S&P 500. And we saw small caps or the Russell 2000 underperform by a decent margin, which has become a theme over the last few years in the market.
The Russells ended the year on a strong note and is off to a good start in 2026. Bad first half and a decent fourth quarter. As Brandon, you're a big fourth quarter guy.
Most important quarter.
That clutch gene.
Yeah, 15% better under pressure is a common saying around here.
Yeah. So yeah, as you mentioned, over the last month, some of the better performers, the international stock index still red hot, up 5.6% over the last month, and Russell 2000 over the last month is up 4%, whereas the S&P is only up 2. So as Jordan mentioned, hot start to the 2026 for small caps, but also a good end of 2025 for small caps. Bitcoin was a bit sluggish in 2025, but that is also off to a very good start here in 2026, almost up 10% so far. Brandon, what are we seeing in terms of some of the individual sectors, both 2025 and so far in 2026?
Yeah, I think as you look at the sectors and, some of the headline news, obviously with, AI kind of being at the forefront and, driving the market, you see technology and the communication sector, both being up above 20% from 2025. But something interesting to look at here is the industrial sector and utilities being up 19% and 16%. And as you think about AI, commonly you're equating that just to technology, but what are also some of the different sectors that are really affecting from, kind of the AI boom? One from overall efficiency, but then also trickle down effects as you start building out, the data centers, the infrastructure, and also have, the demand from the energy output, in order to, kind of fulfill all those needs from AI. And you're really seeing the, industrial sector and utilities pick up momentum from that too. If you kind of just look at the last, 5 years on average, or the annualized return from the last 5 years, industrials have done 14.5%. And similarly, if you look at, the S&P, that's done about 14.5% over the last 5 years as well. So it's interesting to see how other sectors are also gaining momentum from, headline stories like AI and, how it's not just affecting, the large growth in tech companies when you hear the news of how much they're spending and things like that, which we'll obviously talk about in a future slide in more detail too.
Yep. Also worth mentioning, gold and silver had a pretty unprecedented year. Gold up almost 70% over the last year, and silver up 200% over the last year. So everyone always talks about artificial intelligence and the AI boom that's going on. It's those commodities can sometimes go unnoticed. Those have had humongous years. It's also worth mentioning the money market rate currently at about 3.5%. So that's been trending downwards. A couple years ago, that was floating around 5%. So we always just want to make sure you guys are up to date on where those money market rates are currently floating. Looking at the 10-year Treasury rate, right now it's at about 4.2%. It ended 2024 at 4.6, and it ended 25 at 4.1. So it's really been floating in that 4 to 4.5% range since we saw that massive spike up in 2022 and 2023. The next Fed meeting is scheduled for January 28th. And in 2025, we had 325 basis point cuts. In 2026, the expectation is two more of those rate cuts. But I think in 2022 and 2023, CPI and Fed meetings were such a large headline that everyone was waiting to see every single month. I feel like every release there was a 3% swing in the market. I feel like at this stage, CPI releases and Fed meetings don't have as much pull on the market because we've seen how resilient some of these companies and how resilient the economy in general can be, even in this restrictive rate environment. So it's definitely something we're going to keep an eye on how this matures over the next year and how the Fed ends up interacting with rates. But I don't think it's as big of a topic as it has been in prior years.
I
Yeah.
think starting the year at 4.6 for the 10-year and ending at 4.1 is kind of a big deal. It's over a 10% drop in interest rates on pretty much a benchmark for lending rates that helped mortgage um, homeowners and people filing for mortgages or doing refis. You're basically looking at a 0.5% lower this year versus the beginning of the year. That's a big deal. That's a lot of savings for home buyers, and the expectation is that might even go lower. So that should be a benefit to home buyers, and that should ultimately be a benefit to consumers as well. And interest rates, like you said, they're going down for money markets and shorter term rates. That's not good for investors, but that's good for consumers and borrowers. So there is a little bit of a back and forth there that's worth highlighting. In the dollar, when the dollar gets stronger, we get to buy international products cheaper. When the dollar gets weaker, the American products start to look a little cheaper versus native products. So the dollar going down isn't necessarily a bad thing. It did ultimately mean foreign stocks were up a little bit more as a result of that. And the expectation is the dollar still is about 10% overvalued. Doesn't mean it's going to go down 10%. It just means if you kind of use the old economic formulas and you input the numbers, the dollar should be 10% lower. So we'll see how that plays out though.
Yeah, and that tends to be a big tailwind for international stocks. So as we highlighted on the last page, international being up 32% in 2025. This movement in the US dollar of almost a 10% drop in value helped propel those international stocks forward.
Basically a difference almost.
Yeah. Yeah. So some of the recent news stories we wanted to cover, AI bubble. I think that's been a large fear over the last few months for a few reasons. I think investors feel like technology and AI stocks have been on such a great run that it almost might be too good to be true. There's also been a lot of massive AI spending budgets from some of the large companies that are raising fears of maybe overbuilding or overspending without seeing enough return on investment yet. And also valuation hype around private companies like OpenAI. We've seen OpenAI get roughly estimated at a $500 billion value or greater. I think that has kind of spooked some investors into thinking that all of artificial intelligence companies are overvalued. But looking at private markets versus public markets, there are some stark differences between those and how those are valued. I think public markets tend to trade a bit more on fundamentals and things like earnings and profit margins, whereas private markets like OpenAI have some other factors that kind of go into how that's being valued.
Yeah, and Sean, I mean, to your point too, I think one of the big things when you talk about the AI bubble too is, to your point, looking at the fundamentals and taking a step back. One of the things that we talked about in the November webinar was looking at, today of where these companies are valued versus where companies were valued during the dot com bubble, and looking at their valuations. And yes, are they a little higher? Sure, but they're not, completely elevated where we saw, PE ratios, extremely high, which we'll go over a little bit later. But then also looking at the companies as a whole, you can see that these companies are profitable and have been continuing to grow. So from an individual company, they are strong companies that are making large investments to AI. But the sustainability of them, as an individual company, I think plays a part in it too, even though they are, investing large sums. And eventually, we'll kind of see how the, investments come to fruition from a returns perspective too.
With Verizon's whole network down, we better start investing in the cell phone tower network.
Yeah. All right. I'm sure you've heard the recent stat that there are more private equity funds in the United States than there are McDonald's franchises.
I don't know if people have heard that, Luch.
That
I'm gonna say that's not
was
common,
news to me, Luke.
walking down the street knowledge.
This has been a trending headline. I've seen it all over the place, heard it on a couple of podcasts too. I thought it was interesting. It's definitely been gaining a lot of traction. There's almost 20,000 private equity funds in the United States. You couple that with the current administration recently announcing in August of last year that alternative investments like private equity, crypto, and real estate could be added to 401k retirement plans. We actually wrote a whole article on that. So if you're interested in reading more, you can go to grwealthplan.com, go to our blog section. Sean did a nice job with that one. But overall, private equity has been gaining a lot of popularity and a lot of talk. So as we kind of keep our ear close to the ground, it's something we just wanted to highlight. Many investors are using alts like PE as a way to diversify and hedge equity markets. They're really chasing big returns over long time horizons there.
Love it.
One thing I would just kind of add to that whole private equity story, because you'll see a lot of we get a lot of emails all the time. Jordan, wouldn't you love to get your clients exposure to SpaceX and this? And it's like very buzzword heavy. The private markets operate a lot like the public markets. They're not some magical mythical place where returns are just suddenly higher and everything's suddenly better. And it's always 72 and sunny and it's wonderful. The private investment space, it is less liquid and therefore there is some better return potentials, but it still follows effectively the same cycles. They're still subject to the same lending issues that public companies have. It's a lot of the same dynamics. So I think, some investors, and we certainly hear this thematically, that people get very excited about private investments and, oh, you get in on the ground floor kind of thought process. Ultimately, those ground floor success stories can be a lot greater, but there's a lot more failure as well. If you make it through the grind of making it into the public market, it means you survived a lot of the harsh conditions that small and private companies have to survive. And with that, you probably have some moat around your business, and that can help you survive and endure through bigger cycles. But it is not necessarily, it's just a space with a different characteristic and a different dynamic when you're investing. And it requires a lot, I would say, a lot more understanding and knowledge about how those investment profiles and programs look like. I think there's a lot of education to be had there. It's actually one of our goals this year is to help people understand that space a little bit more in some of our other media. So just wanted to highlight, private equity. It's worth having a conversation with your favorite AI companion about what some of the aspects of investing in private equity are, or looking up some articles and reading about it if it's something you're interested in to learn a little bit more. And obviously, we're always here to help and answer some questions if that's something that people have brought up to you, or you saw something in your inbox or wherever else that just made you curious. We're happy to help people navigate understanding that a little bit better.
As much as I love my AI companion, Jordan, I always get more out of my conversations with you.
Oh, Luch. New
Huge.
year, new you.
All right, something else we wanted to highlight with recent headlines is how markets react to new information. We're going to kind of draw on the recent headline of Fed Reserve Chair Jerome Powell having that press conference stating that the DOJ kind of threatened them with criminal indictments, as an example here. When this happened, markets kind of shrugged their shoulders with no strong negative reaction. The three things that we wanted to highlight here were that President Trump putting pressure on the Fed to cut rates is not really new information or new news. Tensions between Trump and Jerome Powell was not breaking either. Markets have kind of digested this already in the past. And same with President Trump using forces like the DOJ to kind of sway. This wasn't breaking news anymore. What was new information was how Powell used that press conference to vow that he will remain in his role and continue to set monetary policy without being swayed over political fear or favor. So this was new information that markets seemed to digest well.
Yeah, I would add to that also Senators Tillis and I always forget Susan's last name. The Senator well, I'm not going to even try, but let's just say two Republican senators came out and said that they would not approve Trump's new federal chair nomination if this issue was not resolved by the time. And this is really happening in May. So part of the reason I think the market took this a little bit as a shock is why are we putting on this big pressure campaign? You know, if Trump wants interest rates lower, he just sits on his hands and doesn't make a lot of noise about it. He nominates someone, there's not a lot of suspicion of what his agenda is. He's making his agenda of trying to get the Federal Reserve to lower interest rates kind of very public with some of this behavior. Obviously, Jerome Powell coming out and, kind of standing up to him. This has been going on for a while, like you said, Luch, and this was probably the biggest and fluffiest of feathers that Jerome Powell was. He didn't just post this on the Federal Reserve website, he posted it on multiple channels so it could not be deleted and take it down. And he did it on the Sunday after they were served subpoenas on Friday afternoon. So he didn't really, he took the weekend to think about it and then was even more defiant in how he wanted to respond. But the fact that he got a lot of support, apparently he is one of the most popular public figures in Washington, D.C., which I find that almost appalling, but not because he should be lower or higher. Just I'm surprised the Fed chair is a popular guy in Main Street world. And I think the fact that he's gotten a lot of support both on both sides of the aisle, and even when you look at some of the earnings that have come out so far, Jamie Dimon made a point, and Trump actually criticized him afterwards, of saying that Federal Reserve independence is really important. There's been a lot of other people that have echoed that. There's been a bit of backlash. So I think one of the other big pieces of news here is, where really when Trump has acted, a lot of people have just kind of remained silent and just kept their head down and avoided, falling into the fray of fire. This is actually, people are starting to, I would say, give more public pushback. And there seems to be a little bit more course around it. And I don't know if that's because it's the midterms this year, so people are just trying to posture or whatever else. I don't know if, like the Exxon CEO saying they have no interest in investing in Venezuela after that seemed to be one of the big motivators. And, he got a lot of let's call it political talk in the White House regarding Exxon maybe not being allowed to be involved in Venezuela. It's an interesting dynamic of what's kind of going on. And I was listening to some commentators on CNBC. There has never been a time where there has been one individual who has controlled so many news topics or been at the forefront of so many news topics. And this is certainly an interesting time, but let's not go too far down that rabbit hole. Let's keep going.
Yeah. One thing Jerome Powell always says is he's going to remain data dependent. So he's sticking to his guns with that one, with his response, I think.
I mean, making the accusation that this was completely political motivated is, that was strong. But anyway, let's go on.
That's crazy. Uh, so here we have a chart showing the S&P 500's historical price to earnings ratio from about 1950 to now. And the price to earnings ratio is really a valuation metric that you can see. So you can determine, is this overvalued? Is it undervalued? And right now it's sitting at about 23. And if you look at the average over this time frame, it's about 19. So, from a technical perspective, yes, you could say it might be a little overvalued. But it's also important to look at the context, of this chart. How have companies changed over this time? One of the big questions are, are investors willing to pay more for, specific companies and, indexes and things like that as we look at what it's made up of today versus what it was made up of, 30 years ago. So even if you look at, 1990, the top 10 companies in the S&P 500 at that time were companies like, IBM, Exxon, Philip Morris, versus if you look today, it's really technology heavy where you have NVIDIA, Google, Apple, Microsoft. So it's not exactly the same, companies that you're paying for or even industries that are leading it, where it used to be, more commodity driven and energy driven versus, today in technology. And I think that also kind of leads to, the profit margins discussion as well. And that's why I included those bullet points at the bottom is looking at, the S&P 500's profit margin today versus going back in time too. And, leading back to, yes, the PE ratio is, higher today, but how much of a difference, is that? And are you willing to pay more for companies that are making up, the S&P 500 today because of their profit margins, because of those fundamentals that Sean mentioned before when we were talking about the AI bubble. And, while, like I said, is it, valued more? Yes, but is there a fundamental reason for that? I think that's also something you have to look at. You can't just look at, the historical, oh, it's valued higher today than it was, 30 years ago or 20 years ago. Kind of have to take a deeper dive into some of the rationale why we're seeing that.
That's an awesome point, Brandon. I think this is, really hitting a nerve right here on sometimes where context and knowing enough to be dangerous versus knowing enough to really understand what some of the drivers are. And even if you look at the numbers that you presented here, in the 1990s, you were running at about half, less than half the profit margin that we're currently running at in the S&P 500. If you walk around and ask economists, they'll tell you that profit margins are in fact mean reverting, which means that there's a long-standing assumption that profit margins will revert to the mean over time. The reason why it probably hasn't, if you want to go to the economist that will explain, well, why is it so much higher? The argument they'll make is our antitrust laws over the last 25 years have no teeth. So we have monopolies and oligopolies that are behaving. A good example is Google has over 90% of all search volume. That's not exactly a competitive market. That sounds almost like a monopoly. Certainly would qualify as an oligopoly to know that only two other searches control the next 8%. So that probably explains a little bit why. I mean, and that's the Mag 7 are really driving a lot of this. And so, if you're a monopoly, you can have above market or higher than normal profit margins. And I think that that's not necessarily a complaint on capitalism or anything like that. I mean, it is what it is. But that's also why you possibly see larger multiples. These companies can go around, they can push around markets, they've got a lot of cash, they've got a lot of borrowing power. And they also have a lot of consumer power. And I mean, even, looking at the situation today with the Verizon outage, I mean, over a third of the country right now is having issues with their cell phone. I mean, that's what it means when you kind of have these segmented markets into only a couple big players. And there's a pro and con to that. But one of the pros is your profit margins will be higher, and maybe it's better for consumers. I think this is one of those arguments that go on back and forth, but it at least explains why the multiples can potentially be higher if the quality of company or the earnings they're able to create go up over time. And that's what this chart is effectively showing is there's a little bit of a drift up, and that would make an argument for a multiple going up. Someone had a question here about it seems like we're going to have inevitable conflict in Iran, and what does that mean for the U.S. economy as a whole? Iran is not really a trading partner with the United States. Iran is one of the major oil producers and shippers. We don't buy Iranian oil, but others do. China being one country that's a big consumer. And probably the issue, anytime you have instability in the Middle East, usually oil prices will go up. I mean, that would be probably the biggest issue you'd see. And then maybe the defense contracting stocks go up. Those have also been one of the best performing sectors is aerospace and defense. That seems to be a theme that's going to continue to play out, especially with some of the rhetoric and, what's been going on in the news and the headlines. So that's probably the biggest impact. I don't think the US consumer, though, is going to change their behavioral patterns because Iran is, we're in a conflict with Iran or not. The same way I don't think that before we, decide to go out to the movies or, buy a new pair of shoes at the mall, we probably don't ask ourselves, well, do we think this Venezuela thing's gonna, escalate? I just don't think it's in the forefront. We're pretty isolated here in America from kind of some of those issues that are going on when we just think about the consumer and the everyday economy. And the biggest part of our economy is ultimately the consumer and government spending. So, companies I don't think are going to invest any differently based on Iran. I don't think that Facebook or Meta, I should say, is going to change its AI investing scheme based on whether or not we're invading Iran or doing anything else. Um, and while it certainly doesn't, it's disheartening to see all the conflict going on in the world and all the protests and everything else. There's certainly a lot of anger and angst amongst populations. But at the same time, a lot of companies have decided that they're, investing in AI and that's what's pushing the market forward. A lot of consumers are, hey, with all that's going on in the world, I'm going to make sure my kids have a great Christmas morning. And so we ended up getting some of the best consumer numbers in the fourth quarter for Christmas. So, I don't think that it really impacts. I think that people are feeling close to family. They want to do good things for their kids. People are out, and while the job numbers, if you're measuring with a millimeter stick, are starting to weaken, but overall, jobs and joblessness is pretty low, and the economy is doing pretty good. I mean, I was listening to economists who expects us to be over 5% GDP this year. So while there's a lot of headlines, and if you read the newspaper, it can, sometimes cause you to go green, but at the same time, the market stays green. So it's just kind of one of those interesting times where it doesn't all make sense, but it doesn't mean it's wrong. So we would probably tell people while the headlines can seem very scary, the market is very much focused on what's earnings growth, what is the productivity gains we're potentially going to see from AI, and is anything breaking really badly? And as long as nothing breaks really bad, it seems that the market's happy to just move right past. That I think it probably has whiplash at this point of the news cycle, just the same way everyone else does. Ooh, earnings growth expectation.
Perfect segue, Jordan. The health of the
Boom.
economy, what earnings expectations are going to be in 2026. If you look at the S&P 500 as a whole, the expectation is that earnings are going to grow by about 15% over the next year. We highlighted some of the individual sectors that are there. Information technology, which is a lot of those AI companies. Expectation is that in that sector is 29% earnings growth over the next year. You also have materials and industrials. So industrials includes a lot of those aerospace and defense companies. As Jordan just mentioned, that's been a large theme over the last couple of years, and I think is going to continue to be a theme given those headlines with countries like Iran and Venezuela. Some of the industries that are on the lower end of earnings growth expectations, consumer staples, only about 7%, energy is only about 5.6%. While that sector can be influenced a lot by supply and demand and geopolitical conflict, there's not a ton of earnings growth that happens in the energy sector. And then real estate is down at about 5% expectation for 2026. We also see utilities at around 9.7%. I feel like that is partially artificial intelligence at this point because AI data centers are so reliant on utilities for energy. So that's become kind of an extension of the AI sector in a way. But in general, 15% expectations for the S&P earnings growth in 2026. I think things are looking pretty bright in terms of what is expected from the market.
So I invite all of our listeners and attendees to jump in as well. But I'm gonna go quick around the room with you guys. What do you think, if you could boil it down to one word or one phrase, what do you think would describe what 2026 markets are going to be all about? Luch, come on, you got something.
I think it's going to be interesting to keep an eye on international markets and seeing if they continue to outperform in 2026.
All right, international versus US. I like that. Brandon, what are you thinking?
Um, I would still say, AI coming in from last year into this year and seeing how companies, if they can equate any AI, investments into actual return or numbers or actual, efficiency data of how much AI has actually helped in certain areas and things like that, and how that continues to kind of escalate throughout the year.
Yeah, AI ROI. I love it. Sean, what you got?
I'll trademark that.
I like the AI one as well, but just to be different, I'll say taking a look at small caps. Maybe it's the year that small caps start to outperform the Mag 7. The Mag 7 has really led the charge over the last 3 or 4 years. When is the other 493 going to step it up and be able to compete with the Mag 7? So far in
Hmm.
2026, it's been a good start for small caps, so we'll see how that trend continues to unfold. How
I
about you,
like that.
Jordan?
I'm going I'm going with the 10-year.
Okay.
I'm going with the 10-year. I think the 10-year is going to be in response to inflation,
Mm.
which I don't expect anything exciting with. But inflation, whether or not we get a slowdown in growth or a speed up in growth, which I think is kind of getting to Brandon's point about ROI and if AI and the boom in CapEx spending keeps going. And with Luch's comment about international, I think if the dollar moves significantly, that's going to drive international returns one way or the other versus the US.
Mhm.
And the dollar changing could be also very impactful to 10-year. So I think if you want to boil it all down to what to keep an eyeball on, I think the 10-year is t saying a lot, but we'll see. I was supposed to only say one phrase, so 10-year.
Yeah, we all went over.
All good. Well, I think we're at time, guys. Um, this is exciting, man. 2026. And I can't believe we're here. And I can't believe that 2025 was the year that it was. Looking back and doing my commentary for the new year, and I went through each month and went through the headlines. And by the time I got to March, I had already sat there reading over 200 headlines. So. It's been a pretty nuts run, and it doesn't seem like 2026 is going to be any different. So
Yep.
stay tuned and hang in there, and wishing everyone a healthy and happy new year.
Awesome. Thanks, everyone. We'll see you next month.
Thank you.